Good morning, and welcome to the September 2025 update of the Spears & Associates Drilling and Production Outlook. I'm John Spears, and I'll be your host for the next 60 minutes. We're recording this podcast on September 5, 2025, so the first Friday in September, and as I'm sure most of you know, that the first Friday in September is National Be Late for Something Day. Now, I mention that only because you'll notice Richard's not here to join me, but it's not because he's late. He's just attending to business on the western slope of the Colorado Mountains. So we'll give a couple more minutes for folks to log in if they're observing the holiday. For those Texans who have signed in, this is the anniversary of Sam Houston's election as president of Texas back in 1836. In 1774, it was the day that the First Continental Congress convened and immediately declared a trade embargo on Great Britain. So trade issues have been an issue for this country since literally day one, something to keep in mind. And in 1698, Russia declared a tax on beards. So we might I think it was sponsored by Gillette now that I think about it. And so we might keep that in mind. Governments will go to almost any action whenever they need revenues, and so those of you with beards, remember them fondly. There's been a lot of big news this last 3 months since we've did our broadcast. We want to use this session to sort through some of the headlines and look at the factors that drive CapEx decisions in the upstream sector, and what that means for short and mid-term drilling and completion activity here in the U.S. and in countries around the world. So in the first part of this session, I'll go through a slide deck that summarizes the current state of the oil and gas market and what's our updated drilling and production forecast. After that, we'll stand for questions. So these can be sent in via the webinar chat box. I'll try to get to these answered if I can during the course of the session. Some questions have already come in that were sent to us directly, and you can also send them to via our email address at sai@spearsresearch.com. One more piece of housekeeping. Rather than sending out the slide deck and the supporting PDF and Excel files directly to users as we've done in the past, this time we've posted the information to our website for DPO subscribers, and you can access this via logging in and setting up a password and so forth. So let us know if anyone from your organization is having trouble doing this, and we'll make sure to get things straightened out. So finally, feel free to link this webinar on social media, particularly LinkedIn, where it's being broadcast right now. The details of the forecast are for our subscribers, but this discussion this morning is free and available for those linking on social media. So we wake up today seeing that oil prices are down. WTI is trading around $62 a barrel. Brent is around $65.50 a barrel. Henry Hub's around $3.10. So at the same time, there are various forecasts being put out by investment banks that oil prices are headed to the 50s because we're on the cusp of another meeting by the OPEC Plus crowd in Vienna, Vienna this weekend. And the thought is that they'll probably continue to raise output as they chase market share as opposed to price stability. So this is an interesting time for us all to be thinking about how to put this together and what this means for activity next year. You know, the cadence that we normally see in the oil patch is that July, August is sort of the period when oil companies began to put together their longer-term outlook, and the upshot of that is where do we think oil and gas prices are going to go, and then based on that, the next months, August, September, is when they begin to work into preliminary plans for drilling activity and the like, spend on completions, production, and whatnot. And then they take September, October, maybe into early November to collect pricing information from the service firms so they can finalize their budgets. which then in turn began to be blessed to get a final investment decision taken on those in the November, early December timeframe. So we're at a strange point right now where operators themselves aren't clear as to, haven't made their plans as to what activity next year might be. So we're trying to understand all that and begin to think about how that's impacting their decisions going forward. So with that, why don't we turn our attention to think about activity for next year. So with that, we'll tend to the first slides in our slide deck. Those of you who are longtime members here and have seen our work for these many years will recognize these charts. It looks at the global oil market in a macro sense. Where is demand today and where might it be going in the future? And where is supply and where that's coming from now and over the next 2-3 years. So change in oil demand on the left-hand side, as you can see, this year is estimated to be somewhere around 1.2 million, this year is around 1 million barrels a day growth. Next year is up to around 1.2 million barrels a day. These are numbers that the Energy Information Agency in the US has put out. We believe that those numbers will stay fairly steady for the next couple of years, 2027 and 2028, beyond their short-term forecast of the EIA. What's interesting to me, and as I always take pains to point out, is that the bulk of the growth that's been taking place and that we expect to continue to take place is in what is broadly referred to as two categories: other Asia, so not China, and then rest of world, which generally picks up South America, Africa, Central Asian countries, and the like. And so as you can see, those two groups collectively have been right around 1 million barrels a day growth in oil consumption year over year. I only go back as far as 2024 in this chart, but believe me, it's been the same for quite some time. So this is a hard part for the market to measure. It's fairly opaque. The data comes in slowly. And one of the things we should all be aware of is the fact that the three major oil forecasting groups, the International Energy Agency over in Paris, the EIA in Washington, D.C., and now OPEC Research in Vienna, all have vastly different takes as to where consumption is going to go. As one might imagine, the Paris group now believes that global oil consumption will only grow about 700,000 barrels a day this year and next year. OPEC Research on its side is now about 1.3 million barrels a day growth both this year and next year. And I'm sure that's one of the reasons why OPEC is feeling comfortable that it can continue to add barrels to the marketplace, because it just fundamentally doesn't believe it's going to oversupply the market to the extent that that the Paris and Washington crowds currently believe. And so we have to keep that in mind. For example, Standard Charter was just this morning released an outlook for the market that called for oil prices to fall into the 50s, pending an additional bump in OPEC Plus production. And I suspect that's because they have a pretty bearish look, or certainly on the low side of what global oil consumption might be. So it's a hard thing to parse out, but there's this just fundamental disagreement as to how fast oil consumption might rise. I think that the combination of lower oil prices, so oil prices are down on the order of about 15% this year from last, lower oil prices, and a weaker dollar, since oil is priced in dollars. So a weaker dollar all means that to a large chunk of the world, oil is getting less expensive to use. And we all know that when prices go down, consumption goes up. And I think that's what's powering this demand growth that we see in other Asia and in rest of the world. China is bumping along somewhere around 200,000 barrels a day growth year over year. Again, that's a hard one to measure because the Chinese are pretty opaque, don't really release their consumption numbers. And so we're all kind of guessing at that. but they appear to be well below their past growth rates, but something that's still positive. So anyway, those are the assumptions we've made. When you turn over to the supply side, you see that, of course, this year we're getting an awful lot of extra barrels come into the market. Surprisingly, it's this rest of world category, or other, on our right-hand chart, that has really grown this year, but that swings back and forth pretty substantially. Last year, the other part of the supply picture was negative. This year, it's up about 650,000 barrels a day. Next year, we think it'll be down negative. So you get a lot of back and forth in that particular category. Clearly, OPEC, as it begins to raise its own production, will probably capture on the order of about 50% or maybe a little bit more of the net increase in oil consumption going forward. And I think that's largely behind what they're intending to do. They want to recapture market share as opposed to defend prices. And it looks to us that they'll be successful in doing that, largely because U.S. oil production is beginning to roll over. So here are our numbers for crude oil on the left-hand side, natural gas liquids on the right-hand side. We want to highlight both of them because a lot of times when we hear about U.S. Oil production growth, it's the combination of the crude oil side and the natural gas liquid side. And on the crude oil side, we've certainly seen signs this year that that the production growth has stalled. And given the drilling forecast that we've put together, when we tie that to what we think will happen on the production side, it seems to call for output here in the U.S. to decline next year on the order of about 100,000 barrels a day year over year. So perhaps continuing to grow after that. I think we all recognize that some of the inside baseball factors that affect production numbers, like rig productivity, and so how many wells are being drilled by a rig, that continues to grow 2 to 3% per year. What's happening to well productivity, so how many barrels per day does a well produce, especially when you measure it in terms of initial production, that continues to grow as well. So both of those factors help mitigate some of the decline in rig activity that we're expecting to see. And so, but next year anyway, we think oil production will be down. And I think, again, another investment bank has just come out that says 2026 will be the peak year in U.S. crude oil production. And we can't really disagree with them too much. We think this might be the year that crude oil output ends up peaking. Now, recovery a little bit going forward, but not much, except on the natural gas liquid side. Natural gas liquids, of course, are stripped from gas production and processing plants. And as you can see there, we continue to experience a pretty substantial growth year over year in gas liquids as we produce more gas. 80% or so of the natural gas liquids, of the gas that we are producing now, is run through a gas processing plant in order to both purify it for pipeline transmission, but also to take out the gas liquids, because the gas liquids market has been very strong. We export about 40%, I think, of these natural gas liquids to places around the world. I think China has typically received about 40% of the ethane that we export. So they're a substantial part of the natural gas liquids story. But when you combine the two numbers, crude oil and natural gas liquids, we'll see U.S. liquids production continue to grow a little bit next year. But again, all the growth has taken place on the gas liquid side. I should mention, that the various trade issues going on between the U.S. and China right now, we've certainly seen propane and ethane as sort of central to that dispute because China relies on it so much. The other thing going on in China is that it has way too much production capacity on both the refining side and on the petrochemical side. And as a country, it has decided that it wants to reduce its over surplus capacity in both those areas. And as it does that, this and as disputes over trade terms evolve between the U.S. and Canada, I think we could see the sort of the feedstock issue and exports of NGLs shuffle around a little bit. But in any case, those are the numbers as we see them right now for crude and natural gas liquids production. On the gas side, just spend a minute talking about what we see happening in terms of the LNG market. Globally, the market is somewhere in the order of around almost 60 BCF a day on a global basis. You can see who the major suppliers are. The U.S. gets about a quarter of the export market. Qatar, which was number one for a long time, is around about 20% now. It's expanding its capacity, and so I think it'll capture a larger share going forward. Australia, which is not increasing its LNG export capacity, is currently around 18%, but its share will probably fall going forward. But those are the three major players, and when you put the numbers together, they get somewhere around 65 to almost 70% of the LNG trade. And of course, one of the things we certainly see going forward is that LNG export capacity in the U.S. is headed up and to the right. Some expect it to double as soon as 2030, and this will help sustain and put in play an interesting situation on the gas side. We'll talk about that in just a second. The only other worries I have about LNG trade is that the European Union, which currently accounts for about 30% of the LNG demand out there, still has plans in place to cut its use of fossil fuels by 2030. Now, what does that mean? Will that mean that it lowers its overall gas consumption, or will its efforts to reduce natural gas consumption focus on LNG? And I mention that only because LNG is a much more expensive option than pipeline gas that might come in from Central Asia or North Africa. And so I don't have much clarity on that particular point yet, but that's a red flag, or certainly a pink flag, I guess, with regard to forecasts for the LNG market. The other thing too then is China. China has typically been 15 to 20% of the LNG trade, but these days it's kind of appears to be shifting away from more and more LNG, and instead increasingly relying upon pipeline gas from Russia and from Central Asian countries. There was a big meeting just last week between Russia, China, India, and various other countries, and in part of that meeting there was an agreement between the Russians and the Chinese to build a second big export line, Sibiri 2, that would bring Russian gas to China. And so again, you can begin to see where Chinese are beginning to turn away from high-cost LNG imports and instead relying upon pipeline gas from places like Russia. So we'll have to keep an eye on these, but at least in the near term, there seems to be a pretty strong consensus that the market will continue to grow going forward, and we'll be able to participate in that. Pardon me. So what does that mean in terms of natural gas here in the U.S.? Well, two elements then. We look at the natural gas that we consume domestically. That's about 80% of the market. And then the gas that we export, and that's the other 20%, right? On the domestic gas consumption side, the chart on the left here, three parts of the bar: power generation in green, the gas demand for power generation, industrial, which is the black part of the bar, so power gas use in the industrial sector, and then we've combined all other, which is primarily residential and commercial. And really the growth that we expect to see in the U.S. consumption side is all about the power generation market. AI, data centers, to a certain degree crypto, all sort of power what is expected to be something like a 4 to maybe 5% CAGR in power generation gas demand going forward. We're also seeing some closure of coal-fired power plants. So the reduction of coal-fired power and the increase in demand for power really means that demand for gas in the power sector is is expected to jump and grow strongly over the balance of this decade. So that's the green part of the bar beginning to move up. The other two areas are fairly flat because I think the combination of rising power demand on the left-hand side chart and the fact that U.S. gas exports, primarily LNG, are going to grow so fast on the right-hand chart really augurs for a higher natural gas price going forward. We've got our own estimates of how high that might go and roll that into drilling activity estimates going forward. But it's going to be a struggle, I think, for the U.S. to supply both of these markets as they grow going forward. And someone's going to have to pay, and everyone's going to have to pay a higher price. And that, I think, means that we'll see a fair amount of price-induced conservation taking place over the industrial and the residential sectors going forward. So here are these price assumptions that we've made. Again, trying to forecast prices is like trying to catch a falling knife. And so we use these averages. So these are averages. I would think that next year we'll probably see oil prices trade in a $60 to $70 range. Maybe those who are a little bit more bearish would say $55 to $65. We've got an average price of around 62, 63 for next year. So I think that my estimate would be that that's the kind of price band and average price that operators as a group would be using when they begin to put together their budgets for next year. We have a bit of a price recovery going on after that. Again, OPEC can only deliver so many extra barrels to the marketplace, and as demand continues to grow, we think that'll help keep the market and steady and maybe tighten prices a little bit. On the gas side, much bigger jump. So 2023 saw 2024 saw prices average around $2.10 at Henry Hub. This year they're going to come in somewhere around $3.30 to $3.40. It looks like next year we have a price going up to around $3.80, and they continue to march up after that. And again, it all goes back to what we see are two very strong demand elements on the gas side: power and LNG, and a real fight for access to the supply that we expect to be produced. So, pardon me. One of the things we have to keep in mind is if we're correct in terms of our U.S. oil production forecast, right, and with so much of our gas being associated gas production, then as oil production begins to flatten out or roll over, associated gas from those same oil wells will also not grow as fast as it has grown in the past. So production side on gas will begin to shift, we think, in light of these higher gas prices, I should say, that we began to move away from relying upon Permian and to some degree Eagle Ford as the source of much of our gas production growth, like we've seen over the past 4 or 5 years, and now begin to rely more upon the dry gas areas, Marcellus Utica and Haynesville, as the source for any incremental gas production going forward. So I think we've got some slides to that point later on, and that certainly informs our estimate of what drilling activity looks like on a regional basis. So here's our actual numbers in terms of rig count and frac job count and on a macro level, on an overall level. I should point out too, before I get too far into this, that since June we have seen the One Big Beautiful Bill Act passed in Washington. I don't believe I've ever seen a piece of legislation with more adjectives in its title. I'm not sure what that means, but from the standpoint of how that act is impacting the upstream sector, I think we have to say that it's a net positive, but it's not a big needle mover. I mean, there's been some permitting reform that's there. Offshore royalty rates have been lowered from 16.6 to 12.5. There's a certain number of mandates regarding Bureau of Land Management and BOEM offshore lease sales. There's a delay to the implementation of a methane fee to 2035. There's been some acceleration of intangible drilling cost tax credits, or deductions, I should say, in the legislation as well, and there's a bit of regulatory reform as well, but nothing there that sort of would make an operator jump up and say, boy, oh boy, here we go, find me another rig. The other thing too, on the in terms of the overall macro environment that the industry finds itself in, is that we've seen merger and acquisition activity fall, in dollar terms anyway, fall in the second quarter. We'd been anticipating that would be the case simply because the combination of uncertainty about oil and gas prices has just made it more difficult for buyers and sellers to meet on an agreed upon price. Something like the top 40 operators here in the US now account for, by our lights, about 75% of drilling activity. The deals going forward, or the deals that we've seen done, have been less and less that were oil focused. So, again, 2023, 2024, much of the deals were around Permian acreage and operations. And those have certainly not fallen away, but they've diminished. But natural gas focused deals have been trending higher. And again, it's all because operators are continuing to optimize their portfolio, better manage risk, so we expect to see consolidation continue, really in almost every basin, as operators shift portfolios, and so that has some impact in terms of for oilfield service firms, and as we all know, that as buyers and sellers arrange for deals and organizations get combined, that there's a certain amount of churn in the supply chain for the new entity, the combined entity, and we expect that that'll be continue to be the case. Certainly, we've seen it a lot for the past couple of years. Rig count this year, we think, is down about 7%. We come in at around 558 active rigs, a touch over 15,000 wells completed, and around 234 million feet of hole drilled. We think those numbers, well, the rig number we think will be down about 2% next year to around 546 rigs, if I remember correctly. Well count will be up 1 or 2%, we think. Again, rig productivity continuing to drive gains in that area. And footage count will be up another 2 to maybe 4% next year, again, as the wells that we're drilling continue to get longer, as lateral lengths continue to grow. About just the lateral section of wells continues to grow about 5% per year. So more productive rigs, longer wells, and so measured in terms of wells or footage drilled, we don't quite see the decline that we expect to see on the rig side. So frac job count is another one that has softened this year. It's down about 6% this year. It'll be down another 3% or so next year to around 11,000 wells, as best we can tell. And here's where we begin to think about rig activity by type and by trajectory, and also then by region. So you'll see that in the detail that we provide along with our report, is we have rigs, wells, footage, spending by trajectory. So horizontal wells, directional wells, vertical wells by region. So we've got 20 or so different regions here in the US. So depending upon where you are and what kind of market you're serving, there's a lot of information that I think folks can find useful. But when we roll it up in aggregate, to sort of simplify the story, what we've seen, of course, this year is that oil rig count has fallen pretty sharply since March 30th. It's come down from, at that point, oil rig count was running around 480 rigs. Today it's down to just a touch over 400. We think it's going to, most of the decline is behind us now. Pardon me.
Because in the past, what we've seen operators, when they've sort of done a mid-year adjustment to their drilling programs, that they've affected that action, that decision, in about a 2-quarter time frame. And so I think the pain is largely behind us, and at this point, we think going forward, again based on our oil price estimates, that the oil rig count numbers will generally hold flat. Pardon me. What we see happening on the gas rig side, though, is just the opposite. Gas rig count has begun to climb this year as we've seen gas prices rise, and we think that'll continue to be the case for the balance this year and into next year as well. So again, those basins then that are more gas prone, we think will actually see a net increase in activity next year, and you can begin to see a little bit of that on the right-hand chart where we look at activity by basin. And here all we're doing is plotting horizontal rigs. And for just these 5 areas, there are maybe another 100 horizontal rigs currently working scattered across other areas outside these 5 areas. But combined, these areas currently account for about 70% of the rigs, horizontal rigs working, and so they're the key ones for all of us to keep in touch with. Pardon me. Again, the Permian next year we think will be somewhere around 250 rigs on average, down from a run rate that was around 300 at the start of this year. Eagle Ford will be down a touch, Bakken will be down a touch. But Marcellus, Utica, and Haynesville, we think, will be on the increase. And again, as we tied to the changes we expect to see on the natural gas price side. And then again, we take these rig count numbers, make some estimates around productivity, well productivity, rig productivity, decline rates from existing production, and what does try and translate into what does that mean for production by basin. So oil production on the left-hand side for the 4 key areas: Permian, Bakken, Eagle Ford, and then the federal Gulf of Mexico. And then natural gas marketed production from 4 key areas there: Marcellus, Haynesville, Permian, and Eagle Ford. So interestingly enough, federal Gulf of Mexico will be growing next year as we bring on some of these new deep water fields. Permian numbers clearly will be softer. Not much change year over year from the Bakken and for the Eagle Ford on the oil production side. And you sort of see the same kind of thing going forward, although we do expect to see a bit more growth in terms of gas production from the Permian, and that's all because wells are getting gassier. 2 reasons, really. One is the wells get gassier as they get older. More importantly, there's a shift going on in terms of drilling activity. So whereas just let's see, 2023, the amount of wells drilled and so forth is split about 50-50 between the Midland side of the basin and the Delaware side of the basin. Today, now the Delaware accounts for something like 60% of the drilling activity as best we can tell. So, and that's a gassier side of the play. So the combination of, for this shift within the Permian Basin in terms of where the drilling is taking place is having an impact, will have an impact in terms of how much production we expect to see from that area going forward. So the Permian will still be a net grower in terms of gas production. It just won't be growing at the kind of rate that it has enjoyed in years past. Some recovery, though, the biggest part of the recovery in terms of gas production will be led by the Haynesville, which is our orangish bar on the right-hand side, and the Marcellus, which is our tall blue bar there as well. Composite costs, we think, haven't changed very much. We do a quarterly survey. The last one we did was at the end of the second quarter. Prices slipped, or unit costs slipped just over 1% in that quarter as best we can tell. There was a great deal of worry early on this year in terms of higher tariffs and what that might mean to well costs, since there's a significant percentage, maybe 20% of the cost of a well is tied to items made out of steel, pipe, production equipment, and so forth. First off, we haven't seen much tariff impact in pricing, but more importantly, I think the fact that we've seen activity slip, so the decline in activity has and its effect on non-steel costs has overwhelmed any price increase coming from higher tariffs. And as a result, we think well costs have been have not gone up. We think they're declining. I would expect that they'll continue to decline going through the end of this year, and then probably in 2026 hold at about the Q4 level of this year going forward. That's our expectation at this point. Understanding that the tariff story is no, we haven't reached the final chapter in all those what that might mean. One of the things we look at, though, to better understand tariffs or how its impact is going is on the OCTG import side. So numbers can be collected each quarter on what we're importing on for casing and tubing. The top chart looks at what those import costs are on a dollar per metric ton basis, and as you can see, those prices have certainly stayed under control. The broader story is that pricing has fallen basically since the middle part of last year, when it was somewhere approaching $1,500, a little over $1,500 per metric ton. These days, the number is closer to about $1,200 per metric ton. So again, the decline in activity, I think, has overwhelmed any price increase that might come about because of tariffs, and we've certainly seen that be the case. The other thing that's part of the supply-demand story, at least for casing and tubing, is where do we stand in terms of imports? And even though import prices have been basically flat to down, import volumes have actually been up. So in the second quarter of this year, total imports were around 500,000 metric tons. That was up from the first quarter of this year, and it's up more than 20% than the same quarter of last year. So, and imports last year were around 40% of the demand for tubulars in the oil patch. So what we see is the import component rising in terms of volumes, demand falling, and that would tell me that inventories at the pipe distributor level are going to be plentiful, and that always means that pricing will be soft for casing and tubing. We certainly expect that to be the case going forward. Looking forward to see how import volumes might continue to change over the balance of this year. Before we get too far away, then, Canada is, again, a number where we've materially revised our forecast from the start of the year. You know, we had seen 5 very good years of growth out of Canada coming into this year, and we're expecting that to remain the same this time, but certainly lower oil prices, down about 17% from this time a year ago, have really caught the Canadian oil patch, and just as we've seen in the U.S., activity has softened relative to last year for the past 3-4 months. Now, natural gas prices are higher, although there's nothing to brag about. Canadian gas prices in U.S. terms were only about 50 cents per MCF in August, which was up from around 40 cents per MCF in August of last year. So the good news on the gas side in Canada is that the return of winter, higher LNG exports are expected to really help boost gas prices going forward. And so we see August gas prices next year around the $1.70 level, so 50 cents this year, $1.70 next year. Peak price of somewhere around $3 Canadian, $2 US in Q1 of 2026. So a gas price recovery in Canada will help stabilize activity and then recover it. Nonetheless, we think activity will be down next year on the order of about 6% as we put all these numbers together. So what's interesting is that, you know, the last 5 years, the growth on the drilling side has been spurred because of anticipated increase in pipeline takeaway capacity, both on the oil side and the gas side. And so what caught my eye a month or so ago was when the federal government in Canada announced that the further expansion of the Trans Mountain Express pipeline was no longer a priority for the federal government. So this is going to be a bit of a challenge because Canadian oil sands production is around 3.5 million barrels a day out of about 5 million barrels a day for total oil production up in Canada. And the Canadian oil sands production number is expected to continue to grow going forward. So the investment taking place both on the mine as well as the SAGD side is really powering further gains expected in terms of oil sands output, and which all needs a pipeline to get to market. So we'll see if other types of, especially crude oil pipeline projects end up moving forward. But for right now, Trans Mountain appears to be a little bit off the case. So, and then finally, we look at the international market. So international rigs this year are going to be down. We think the number is going to be around 869 rigs, down from about 900 last year, so down 3%. Collectively, they'll account for a little over 9,200 wells and just shy of 67 million feet of hole. We think on the international side that activity in aggregate will be up about 3% next year. So one of the reasons that activity is down so much this year is Mexico, which is a fairly significant part, almost 10% of the international rig count, has fallen apart because of the payments problems that Pemex has had with its suppliers. Those have begun to mitigate. Pemex now has a new 10-year plan to reduce debt and increase production. We'll see if that how effectively that gets implemented. But there'll be a net positive next year, we think, on the Mexican story, and that'll help drive overall activity up. You can see the specifics in terms of regional swings year to year. So again, this year we've seen rig count down most sharply in South America. That's the black bars on these various years. Up a little bit in Europe. Some declines in Africa and Asia Pacific, and the Middle East is basically held steady. Next year we think same kind of thing. The Middle East, which is 300 or so of the rigs, will basically be unchanged in aggregate. We'll see, I think, the biggest gain will come from South America, and then small 2 to 4% increases in Africa and in Asia Pacific. So a bit of a regional difference going on there. And again, so depending upon where you're serving, the markets you're serving, or where you're at, the numbers are in the forecast to specific to country by country and region by region. The other thing we take a look at is what's happening on the offshore side. So again, this year, in terms of onshore activity, we've seen a bit of a decline, and also the same case for offshore. In fact, offshore activity is down a little bit more. But we expect both of those numbers to recover going forward as Mexico improves, as we've seen some recovery on both Asia Pacific, which is largely an offshore recovery, and a bit off in Africa as well. So we have offshore activity growing a little bit faster than the onshore numbers in 2026. And then here's a breakdown in terms of highlight activities by region around the world. So as you can see, Central and South America down 11% this year, up 9% next year as Mexico recovers. The Mexican story is the big one in the area, then big new news there. Part of their production recovery is to begin to develop two of their shale formations, the Pimienta and, of course, the Eagle Ford formation as it's south of the Rio Grande. So those will be of interest and to many U.S. service firms who are very familiar with shale operations and how to go about doing that. ExxonMobil is in Guyana, of course, is moving from strength to strength there. I think its ninth project is this long-tail discovery, and off of Trinidad, Exxon is trying to acquire deep water blocks, and so as it wants to see if the formations that it's developing in Guyana extend into Trinidad waters. Venezuela is an interesting story because Chevron's been re-granted license to operate there, and that I think is important because it may attract some return to the Venezuelan market on behalf of other major international players, particularly Repsol, who was there in a big way. Before we began to get crosswise back in the late teens with the Maduro administration. Europe is up this year. We think it'll be fairly flat in 2026. And in fact, we don't see much growth in the European market over the balance of our forecast through the end of the decade. UK is really struggling. I think there were 4 exploration wells drilled there last year. Very few, certainly no more than that being drilled this year. The big discussion, and we'll find out in the autumn budget by the government as to whether they will repeal or replace this energy profits levy. So back in 2022, when oil prices skyrocketed, the government put basically a windfall profits tax, energy profits levy, in place that has not been repealed or sunsetted, and it's a real issue in terms of for operators and their budgeting and free cash flow available for further investment. Norway's going from strength to strength there, mostly focusing on multiple small to medium-sized discoveries that they want to develop as a cluster. Africa down about 6% this year, up a little bit next year. You see a lot of things going on. Algeria just made the news for, I think it was ExxonMobil, who wanted to discuss with Sonatrach ways to develop their gas shale reserves. So Algeria's got major conventional gas fields, but it also has a substantial amount of unconventional gas. I think it's maybe 3rd in the world in terms of unconventional gas reserves, none of which are being produced. Exxon and others have been in discussion with the government in order to have access. That's Algeria. As you can see, there's various other development projects going forward. The thing about Africa, and we all have to remember, is that Europe wants to diversify its gas supplies now that it has largely cut itself off from Russian gas. And so the pipeline sources are either going to be Central Asia or North Africa, along with the LNG imports that it'll get mostly from the US. So that's why we're seeing activity in Libya, Algeria, and so forth as a supply source for gas that Europe needs by pipeline. And finally, in the Middle East, not much change in aggregate this year, and very little change we expect to see in aggregate next year. I think the interesting thing that, to me, has been the fact that we're seeing some unconventional fields being developed in Abu Dhabi. So you've got 3 different stories there, a combination of ENI and PTTEP. You have INPEX and you have EOG. All now have new licenses to work in that country, mostly around the development of their unconventional gas. Chevron's returning to Iraq. BP has a $25 billion program for developing the Kirkuk field. So lots of numbers, lots of dollars going into the Mideast market. The issue in Saudi is we keep hearing stories about how Saudi drilling has fallen and is continuing to fall. We haven't seen that so much in the rig numbers yet, but I think there's something going on that we'll probably get a fuller story of in the next few months. Pardon me. It still intends to focus on developing its unconventional gas reserves, this big Jafurah project. And so I think that'll be where the focus of attention will be in terms of Saudi drilling going forward. Is it up, down, or sideways? We think at this point it will be fairly steady, but that may be that's going to be a highlight for all of us to take a look at. Finally, Asia Pacific, down 5% this year. We think it'll recover most of that next year. You've got timing issues that affect activity in a lot of different countries. India is the biggest driller there, 80 some odd rigs all told, and ONGC and Cairn or Vedanta are developing an onshore gas field. That'll be an interesting exercise that'll take billions of dollars to do. And then you have outfits like Murphy working in Vietnam and ADNOC working or wanting to acquire a position in Santos in Australia. That'll be, I think, notice of additional cash being splashed around for development and whatnot. I've got about 10 minutes to answer any questions that might come in. Charlie has posted one, so let me see what it says. You mentioned possible peak oil in an early slide, but all of your 2027 forecasts indicate higher activity in production. Are you a glass half full optimist or over optimistic? Yeah. So the peak oil number is was from one of the investment banks that's just out talking about 2026 in their lights is a peak oil production figure here in the U.S. And I suspect that our differences in terms of absolute numbers is probably within about 100,000 barrels of each other, right? So if we're looking at peak oil in the U.S. of around, or current production of around 13.4 million barrels a day, we have it going down about 100,000 barrels a day next year. The EIA has that number up around 13.4 to 13.5 next year. So it's a fairly tight band around the high-low estimates for 2026 production. Even our recovery after 2026 barely takes us back above where we are today. So it's if you draw it on a different scale, a graph, you would basically say the number is going to flatline by our lights if we're correct. And I think one of the reasons we might be more optimistic than others is because as we track a couple of the inside baseball numbers, so rig productivity, wells per rig per year, feet per rig per year, and the productivity per well, both of which continue to improve. So you're getting more done with fewer rigs than has ever been the case. And we think that will also remain an important part of the story going forward. We're not willing yet to bet against technology improvements, further technology gains, especially when you hear operators talk so much about applying artificial intelligence to their operations and where they can find efficiencies and so forth. And some of the things we hear about in terms of technology improvements on the completion side regarding nanoparticles and the likes, which suggests that there could be further gains in productivity per well. You might end up recovering a greater portion of the ultimate recovery from each well. So, right now when we drill these horizontal wells, we might recover 10% of the oil in place. Some of the completion, the technology improvements on the completion side might boost that number by 50%, right? So, and if we did, that would help sustain activity. It would help sustain the tier 1 acreage that we all talk about, and might improve the productivity of something that's being considered tier 2 acreage today and bump it up into that tier 1 category. So it's those kind of things that for us suggest that we might see a recovery in production after 2026. Again, we're not over-relying upon it because I think operators will be content in many cases to hold production fairly flat. We've certainly seen that from numbers or announcements made by Chevron and the like, that they're kind of where they want to be when it comes to Permian production. So, and instead of reinvesting those dollars into growing production but return them to shareholders, right? So I think that's we have to take into account that mindset among operators, that yes, there might be technology improvements which would allow us to boost output and increase production, but there may be those other operators who say that's great, that just means we can run one fewer rig next year in order to hold production fairly flat. And so that'll be the discussion, I think, within the industry here in the U.S., within the shale industry here in the U.S., particularly to the Permian, that we'll be increasingly engaged at as we go forward next over the coming year and so forth. The other thing that folks have asked us is, in light of this forecast, what does this mean for the oilfield service guys, right? So again, a tough environment, lower rig count, fewer wells, even no growth. always puts pressure on unit prices and those kind of discussions with operators. And so I'm thinking that's going to continue to be the case going forward. On their part, the decisions that service firms have to make is what's our own CapEx going to be in terms of maintaining our fleet size. It's been a couple of years, and service firms have really just been spending for maintenance CapEx, what we think of to just sort of hold fleet size the same, not grow it, right? In an environment where rig count's fallen, frac numbers are what they are. CapEx on the part of the oil service firms has been really just dedicated to maintenance spend. We track in our oilfield market report two different categories. One is spending for rig equipment, so new rigs and components. This is on a global basis. This year, last year was around $8.8 billion for rig equipment, somewhere around $9 billion. It looks like this year, not much growth. And then there's another category that we call unit manufacturing, which covers a lot of the equipment that service firms, non-rig service firms, so frac equipment, well service units, coiled tubing units, those kind of things. That in collectively by our lights was around $2.9 billion last year and this year. So we just don't see spend there hasn't in either of those categories hasn't really been growing, and we think to the extent that service firms are under pressure on pricing that they'll keep tight reins on their own CapEx, which I think then would mean as that things wear out, utilizations over time would rise in that kind of environment, and at some point they'll get to close to a full utilization figure and have a return to pricing power. We've certainly seen that happen on the compression side. Rental compression among the big companies, Archrock, Kodiak, USAC, and so forth, collectively is around 95% or higher, right? And that's effectively a full utilization rate for those kind of companies. And we've seen, their rates in that kind of an environment rise 5 to 10%, depending upon the company, over the past couple of years. So once you get to a full utilization figure, the dynamics of discussing pricing begins to change. We're not there yet for the broader category of oilfield service firms, but and I think to get there, these service firms will have to have a tight rein on their own CapEx and only spend at most just for maintenance purposes. The recent Section 232 extension, where 50% of tariffs are now applied to any steel imported. Do you think oilfield service firms will have to absorb those costs, or will there be pressure on the cost side to operators? Yeah. So again, that's a very critical point. If you look at in the past, activity levels and inventory levels have really, established the melody that the oil country tubular good prices must dance to. And so that's why I pointed out the fact that imports are higher this year, even though activity is falling. That tells me that inventories in the hands of service firms are, pipe distributors have risen relative to last year. Now, much will depend upon what domestic manufacturers, U.S. Steel, Tenaris, Vallourec, and so forth, are doing on their volume side in terms of their manufacturing side. And I don't have the full story there yet, but I suspect that when we've all is said and done, that activity levels and import levels will be more important than tariffs with regard in terms of the oilfield service firm for OCTG. I think where you could begin to see and will see a certain amount of tariff impact is for production equipment and for many of the things that are made in the pipeline infrastructure inside and downstream out of steel. So I think that's where the impact will be felt the most. But for the upstream side, there's a certain amount of protection with regard, as I see it, with regard to OCTG. Production equipment, heaters, treaters, storage tanks, those kind of things are sort of in a less protected category, and so I think that's where operators will be pressured to absorb some of the costs. So
We are dangerously close to running out of time. I will encourage folks, if they have further questions, to please send them to me, J.R. Spears at spearsresearch.com. I'll be happy to answer them, or any of the crowd around here will send them to anybody, and they'll get them to me, and I'll get them answered. In between now and December, when we have our next meeting, if questions arise, again, please feel free to reach out, and we'll respond. But until then, I hope everything goes well for you. We'll be back here first Friday in December, and look to see you then. Thank you.